you launched GMO, you went through such a period of lean times that despite the fact that you were a rabid Celtics fan, you would limit yourself to purchasing one copy of the Boston Globe a week so that you could actually read about the Celtics without drawing down on the resources that you had preserved. Is this a true story?
It's entirely true, with one caveat, and that is that was our first firm, Battery March.
Okay.
We founded in '69 with Dean LeBaron. And that really was poverty writ large. And I sold my interest in that. So I did have a little bit of money set aside for starting GMO.
Now, that actually takes us back, so that's perfect. Battery March was one of the very first in the quantitative space. You were along, you mentioned Dean LeBaron, you were among the very first to introduce the idea of using mainframe computers to quickly and efficiently create large baskets or large portfolios of securities, as I remember correctly. If I remember correctly. Is that an accurate description? And maybe you could give me a little bit of background on how you became interested in quantitative analysis as it related to portfolio construction, and then how that led to the creation or the start of GMO.
We started GMO because basically we fell out with our senior partner, Dean LeBaron. And that's business as usual. It happens in different partnerships. And in terms of quantity, we were value managers. We tried to do rigorous analysis. We adopted a fairly strict dividend discount model. And in the early days, we did it by hand. In the next phase, we did it by those wonderful little Texas Instrument calculators with little metallic strips where we write in simple dividend discount programs. And then finally, we made it up to large mini computers of the prime, now extinct, along with the digital equipments. They came and went very fast, but Boston was a big player in those things. And we had a pretty decent sized computer. And what it did is it did a quick first run on a dividend discount approach. And what it did is it did a quick first run on a dividend discount approach that we were doing by hand. It made the screening quicker and more efficient. And we took everything with us to GMO. When we split from Battery March, I think we took 7 of the original 8 people. And Dean had another good squad of people to keep going with, but we took the original folk. And I like to say they kept the name and we kept the portfolio. So we took our portfolio onto a different floor of the same building, the Battery March building, and kept running. Dick Mayo was really the portfolio manager. I was his chief strategist and analyst, and we split the role and kept going. It was psychologically extremely painful because the clients were uniquely vindictive. Neither before nor since have they taken that attitude. There was something about that tech bubble of '99 that made the clients talk as if we had personally insulted them. We had deliberately attempted to lose them money. In other setbacks, that has not been the case. They have realized that we were trying to do our best and got it wrong. But in that occasion, they really were upset. And the reason they were upset is they completely bought into the new golden era that Alan Greenspan and others were talking about. That the internet was going to drive away the dark clouds of ignorance. and productivity would go through the roof and stay there forever. Underneath that, everything was exactly the way a value manager would want. There were asset classes that had not participated at all. The US REITs, the REITs, they yielded 9.1% at the very top of the market when the S&P yielded its all-time low of 1.6%. And I remember people saying, oh yes, but the S&P has had a higher dividend growth rate than the REITs have had. And we would say, yes, it has indeed. Here are the numbers. The S&P has had 1% a year faster growth rate in dividend growth, and in return, you can have 7% extra cash yield. Take your pick. And the gap between value and growth was as extreme as it had been in 1974, which is to say about half price. It looked like there would be something like 100 percentage points recovery to close the gap. And back in those days, the gap had opened and closed several times. It had been pretty dependable. Small cap against large cap was also as cheap as it had been. So you had value cheap and small cap cheap, REITs off the scale cheap. You had tips that had just been introduced, and tips yielded
4% real yields. 4% real yields. I remember them extremely well, looking at that and thinking, this is completely insane. I'm sorry, continue.
And the regular bonds were equally attractive. So it was, in a way, intellectually paradise. It was psychological hell and intellectual paradise, because you had all these wonderful, clear opportunities and extreme diversions from the dominant growth stocks. And all you had to do was stay the course, which we were just able to do from a business point of view. We lost tons of business in a remarkably short time. That whole rampaging part of the bull market was only from the end of 97, when we were very respectable in terms of relative performance. And then you had 98, 99 in the first quarter of 2000. So just 2.25 years was enough to cost us at least 60% of our asset allocation accounts and a very decent chunk of our value accounts. And that was pretty disappointing for me. It was much worse than I had expected or had experienced in earlier setbacks and in later setbacks. That was really quite vicious to lose that kind of money in 2.25 years from having good performance.